thank you so much for joining us again today. My name is Brian Walsh, and this is a special weekly episode of Your Next Dollar. And, really the purpose of these live streams is to, take a topic that we're hearing about from our members in our one-on-one financial planning conversations or on social media, reading in the news, and then diving into it a little bit deeper, talking about some actual tips or takeaways or things like that. And, really over the course of the last few weeks, we've been getting a bunch more questions about SPACs. So we figured it would be a perfect opportunity to bring in a market expert to really start diving into it and starting with, the basic understanding of, what's a SPAC, how does this work, and everything like that. And just, going through the different aspects that, you all as investors may want to consider as you're kind of researching this project and or researching these different options and things like that. So today I'm joined by Michael Sokol from Nasdaq. He is a CFA and he's the Assistant Vice President for the Market Intelligence Desk and has, decades of experience and really a, unique insight into different aspects of the market. So Michael, thank you for joining me. And, you want to add anything to your background before we get started?
No, pleasure to be here. And you give me too much credit with the decades of experience. That sounds scary, but it's true. So yeah, happy to be on the call with you.
Perfect. And, throughout today's conversation, if you do have any questions, please feel free to drop them in the comments. We'll get to questions at the end. I have a ton of questions that have just kind of been built up over conversations that we've had and, questions that we've seen come up, really diving into the topic. But before we dive into that, I want to address some of the legal and compliance aspects of everything from some disclosures. Just like anytime we talk through things, look at this more as education or guidance. Neither one of us know enough about your personal financial circumstances to provide financial advice. If you want to dive into the weeds on your personal finances, you could schedule a complimentary appointment with one of our financial planners. But especially with this topic, we're going to avoid mentioning specific names or specific people involved with, specific SPACs and things like that. And everyone should evaluate, their own comfort with risk and whether or not they can take on that risk before making any investment, including investing in SPACs or even, initial public offerings and things like that. Cool. So I think we handled the compliance aspect of it. So let's kind of dive in here. I think, overall, SPACs have been getting a ton of attention over the course of the last, I'd say 2-3 months. But can you kind of go through the different ways that companies go public and kind of how they compare with each other?
Sure, no problem. And I think the three different ways, and primarily the two main ones lately, have been an initial public offering or an IPO or a SPAC. There's also a direct public offering, which is a variation on the IPO. But for the IPO, initial public offering, you could think of that as a private company looking for money and contrast that with a SPAC, which ultimately becomes money looking for a company. But in an initial public offering, it would be a company that for the first time that's never sold its shares to the public, meaning to retail investors like you and me or to institutional investors, raises money from the public. And with that comes quite a bit of responsibility, including quite a few SEC filings and stock exchange filings, so that the SEC is not going to make sure a company is either successful or not successful, but it is going to make sure that there's enough disclosure out there so that people can make an informed judgment. So there's a bit of a process that companies need to do to go through this filing process and so forth. And at the end of it all, their bankers will help them in determining the value of the company and how much money they're going to be able to raise. So anyway, initial public offering would be a private company that for the first time sells its shares to the public. And that could just be a software company that grows to a certain point and they're no longer able to get money from friends and family and venture capitalists, and they just want to, get some more money into the company to grow it. A direct public offering would be a variation on this, but if a company is successful enough, has enough cash flow, for example, they may need to be public because maybe they want to allow their shareholders to have access to the stock, or maybe they want a currency to do future acquisitions, but they may not need to raise money right away. So they can do listing on a stock exchange, for example, without raising money. And there's a handful of companies that have done that. And a SPAC is, a little bit different in that it's just an initial public offering of, for lack of a better term, a shell company that's going to seek to merge with another company. So if you're that other company, you can merge with a SPAC that's already listed publicly, and through that merger, you become public.
Gotcha. Perfect. So I think that's a great starting point in understanding kind of the basics of the different options. But, really diving in specifically to, SPACs, could you provide a little bit, of a history of, how long this has been an approach? And then also, why we're seeing, what seems to be a huge surge in, going public using this method.
Yeah, I mean, I think the SPACs have the history. I mean, it goes back to the 1980s where there were blank check companies that would do similar things where you'd merge with a public company and allow this company to become public. There was a lot of regulatory scrutiny on the blank check companies, and they were, in a way, frowned upon. They weren't seen as, high quality companies or a high quality way to go public. SPACs, I believe, had their founding in 1993 was the first SPAC, and they've been used on and off since. In 2008. Nasdaq and New York Stock Exchange had some rule changes that allowed more exchange listings for SPACs. But again, they weren't like a huge thing like we've been seeing over the last 2 or 3 years where they've exploded. I think, a couple of things. I mean, deal making is up generally. You've seen low rates for really since the financial crisis. So there's, less opportunity cost to tie up money for a year or two, and people aren't, afraid to do that. And low rates also means that, there are private companies that can stay private longer, because it's easier to raise capital and they're not forced to come to the public markets. So you have these very big companies that are ultimately become SPAC targets. And lately, there's just greater awareness of some of the advantages of the SPAC structure. For example, the speed to market, because you can end up as a company becoming public after, for example, 4 months, rather than the year or two process that it takes for an initial public offering. Add to that a few high-profile deals and success stories that have made others take notice. And so there's a little bit more confidence in the track record of SPACs. And as you point out, it seems like a virtuous cycle, but as more deals happen, then more people become interested in it, just adding to the number of SPACs we've seen listed.
Perfect. And I think as, at least when, question we get related to SPACs is just, I guess, the process and the timeline. Because don't get me wrong, the IPO process and timeline, it has its own complexities. But it seems like there's a lot of, misconceptions out there on, how a SPAC actually works, across the different timelines. So can you kind of hit on, hey, here's the process that you would experience from a SPAC perspective, and then what those potential timelines may not look like?
Sure. So, a SPAC, as we said, is like a shell company. It has a sponsor or a group of investors that take the company public, and they make an initial investment, and that usually is, on favorable terms to them. And what they're bringing to the table usually is management experience or some ability to do an acquisition in a particular field, for example. So somebody who has, let's say, expert experience in the oil and gas field might decide that they're going to pick an energy company, acquire it. And so people would be incentivized to invest along with the sponsor because they feel as though they can make a good acquisition. The SPAC shares then ultimately are offered to the public. Typically, they're in units of $10 a unit, and the unit consists of a share of stock and a warrant. Usually there's a small warrant component just for some additional upside down the road. But once they go public, there's this pool of money. It could be $200 million, $400 million, for example. And the SPAC is looking to make an acquisition, and the timeline usually is defined. It's probably 2 years is the best example, where over that 2-year period, the SPAC needs to make an acquisition. If not, it needs to return that money that's being held in a trust to the shareholders. So there's some safety built in there. But again, the SPAC has no operations. They're out looking for an acquisition target and looking to merge with a company to bring it public. Most of the times they specify a sector, but it's not always required. And what a SPAC investor, once it's IPO'd, is looking for is the experience management and for the sponsor to be able to make this acquisition in that timeframe.
Perfect. And I think, on the process side of things, another area that we tend to get questions on is related to, let's say I'm, a retail investor and I invest in 1 unit of a SPAC. What happens once, let's say the reverse merger happens and the company that maybe merged with the SPAC becomes public? How does that process work for investors?
Yeah, so as a SPAC investor, you really have a couple of different decision points. So the first is to invest in the first place, for $10 a share. Then normally, you're sitting there with your unit. Usually about 52 days or so afterwards, the units and separate into the common and the warrant. So you could actually at that point decide to, sell the SPAC shares or sell the warrant or some combination of that. But assuming you hold on to all of it, the next decision point for you then would be once a merger is announced, because then you have to decide, do you want to continue on as ultimately a shareholder of this newly merged company, or in the case of the shareholder vote, which you'll be party to, you have an ability to return your $10, your shares, to get $10 back. So you decide at that point, would you like to redeem your shares and get your $10 back? Or do you want to continue on as an investor in this company, now knowing what that is? And so, the stock prices tend to follow a bit of a timeline where it's very flat near $10. And then assuming it's a merger that, people are favorable on, you see a spike in the stock once that merger is announced. And then from there, there's no guarantee that the price is going to move higher or lower from that announcement date, because, as time goes on, whether it's the stock market or whether there's more details that come out about the merger, your shares could go up and down. So you do have some risk of the market there once the deal is announced.
Gotcha. Perfect. So I guess, thinking about it, looking at it from two different sides of the table, on one side you have the company, and then the other side you have, individual investors. So from a company perspective, what are the pros and cons of going public via a SPAC versus the other two options of, IPO or a DPO?
Yeah, I think from a company that is seeking to become public, I think that one of the main benefits of a SPAC versus an IPO or a DPO, which would take longer, is two things. It's certainty on the terms, and it's speed to the market. So when I talk about certainty, an IPO process takes sometimes a year, sometimes 2 years. It's a long process. And, depending on market conditions, there may not be an appetite for IPOs during certain times. It seems funny now because the market is so hot, but there have been times where the IPO window is, considered closed. And so you could go through a long preparation process, and then just the conditions are not good for an IPO. And the way it works is really there's a pricing call the night before you do first listing, first trading. And it could very well be that, that call, you have to make a decision that night on whether or not you think that the price is good for you, even after all that time spent with bankers and working out valuation and so forth. So, there's a little bit less certainty, let's say, versus a SPAC where you kind of know the terms and you're more likely than not to be listing in 3 or 4 months versus 1 to 2 years. So that's the other advantage, is that speed to the market, which of course saves time, management's attention, so they can focus on the business, all their energy, and it can be a cost savings too. Another thing, and I'm certainly not a securities lawyer, so I'm not putting this out there as any kind of advice, but I believe there's more flexibility too around the disclosure, because when you're talking about a merger, you can have more forward-looking projections, and that helps in some of those companies that want to put out pro formas to the market, and rather than an IPO where it's a lot more limited in the SEC and the registration disclosure statement.
Perfect. And then I think, hop into the other side, from an individual investor side of things. I think, from your perspective, what are some of the potential benefits versus kind of potential risks that would come along with a SPAC versus, let's say a company that goes public via an IPO or a DPO?
Yeah, I mean, I think the IPOs and then to a lesser extent the DPOs, they get a lot of attention. There's always that proverbial IPO pop, not always. And is that a good thing? Sometimes that's the company leaving a little money on the table, but there's certainly excitement around an IPO. And going through the IPO process is seen by some as a very good experience builder for companies, particularly around financial reporting and all the things that you're going to need to be doing as a public company, and better to do that as a private company before you are a public company, where there's potentially shareholder lawsuits and things like that if you make a mistake. Possibly though, you can raise more capital in an IPO, especially if there's excitement around your deal versus when you have a SPAC. And we didn't get to it, but if you're that shareholder in a SPAC that takes advantage of your ability to redeem your shares, that's fine for you, but that also means there's less money in that SPAC. So depending on the outcome of the shareholder vote, that SPAC itself could have a little bit less in terms of capital than it thought. And that, of course, then means for the company that's seeking to merge with that SPAC, if there's less capital there, then you have to make a decision. Do you have to bring in additional capital in other forms of financing? So there can be a little bit of risk there. In terms of cash alone, an IPO is seen as a little bit more expensive than a SPAC merger. But once you factor in dilution, it's not so clear cut. So I think it's, it really depends on the company. They really now have these two main options to do it. Some have said that a SPAC, if you want to talk about the risks, is a capital lifeline for what might be a weaker company. And so maybe that's not a good thing long term, in terms of, should you maybe instead go through the IPO process, which, forces a little bit more discipline on you.
Perfect. And I think, one thing that we've seen is, people asking questions about, potential risks that they could face as investors, depending on, what stage, the SPAC is in. Have they, identified a company or not? So can you kind of hit on, from an individual investor perspective, potential risks depending on if a company has already been identified versus not identified from a merger perspective?
Yeah, I mean, and as you point out, like once you invest in a SPAC, the first thing that is you don't know what you're getting in the initial investment. So, that's something that you have to consider. And each of those SPACs have different terms and different management. But definitely once the target has been identified, that takes some of the risk out of it for you because and like we said, you do have the ability to redeem your shares for $10. But once let's assume that you decide to go forward and you don't redeem your shares, in a sense, you're not really a SPAC investor anymore. You're an investor in that post-merger company. And so that post-merger performance is going to be key. And, there's lots of questions around, who's going to run the company and all the same things you'd look for in any investment. And I guess you'd want to know, would I be investing in this company as an IPO, for example, versus a merger? And if you would not be interested in owning this company, if it was an initial public offering, well, maybe you don't want to own it as a SPAC investor either. So depending, of course, on what stage it is, that quantifies your risks a lot more. The Wall Street Journal did a study, and it's a little bit dated, but they looked at completed mergers between SPACs up till June of 2020, and they found that they lost about 12% of their value within 6 months following a merger, even though the Nasdaq had risen about 30%. So again, the point being, you're subject to the vagaries of the market and also to the unique factors of the merger and dilution and all those other factors.
Yeah, and I think, this discussion about, potential risks and everything brings up an important topic. And I think for me, from a financial planning perspective, when people, ask us questions about things like that, I think it's important to take a step back and think number one, should I be investing? Is that the best use of my money? Or should I focus on paying off bad debt or building an emergency fund, things like that? And then even if you should be investing, then I think it's focusing on, the long-term, diversified portfolio that aligns with your overall risk, your timeline, things like that. And generally speaking, we want to limit speculative positions or concentrated positions to less than 5% of that overall portfolio. So I just wanted to throw that out there as we're kind of, putting context around it. We're talking about the risks, from a planning perspective in there as well. So I guess, one question that we've been getting a bunch, I don't know, it was like a 2-week stretch where we got this question almost every day. Then it kind of fell off. But, I think in the news, we were reading a lot about, the recent, spike in interest in SPACs could be representing a bubble in the market. Do you think, that's a concern? And how do you kind of look at that viewpoint?
Yeah, I mean, whenever you see something get so crowded all of a sudden in terms of just the attention, you wonder if there's a bubble. And we on our desk, we have the unique duty, if you want to call it that, of opening IPOs on Nasdaq. So there's a handful of us that we execute those trades. And where there's been days where there have been 15 SPACs in a day, and you start to wonder, is this getting overdone? I think there's a recognition of the SPAC structure as being very, very useful in some cases. So that's part of it. But just to throw some numbers around it, if you go back to 2019, there were 59 SPACs raising just under $14 billion. And last year, which we thought was really crazy busy, ended up being 248 SPACs, so like a 4-time increase in the number of SPACs, raising $83 billion, which again, we thought was pretty crazy. And then so far in the first quarter alone of this year, there's been just under 300 SPACs raising $96 billion. So more than the entire last year, 2020, which itself was a very big increase over the prior year. So I think the caution that people would have to look for is the fact that now you have all these SPACs that are out there, and there's a number of mergers that have been completed, but there's certainly a lot of mergers that are not completed or even announced yet. So there's about over 400 SPACs now searching for merger targets, and with $140 billion in capital. So all of that money is either going to have to be returned to shareholders or find a target. And the targets are well aware that there's all this SPAC money out there, so they can maybe potentially, just using an example, play one off of the other. And does that mean that your SPAC overpays? So that's where I think the bubble could be a risk, is if there's just too many SPACs chasing too few deals.
Fantastic explanation on that. And then I think another, more timely topic that we've seen coming up, related to SPACs has really been, I guess, the impact of, changing interest rates, with like the 10-year, or concerns about inflation in the future. And that seemed to have a really big impact on SPACs as compared to other types of investments or other asset classes. I think high level, can you hit on that, if that's true, why that would be the case, and things that people should be aware of with that?
Yeah, and we've seen that on our desk, because even on days where the stock market itself, and we're at records or close to them for the S&P 500, on days where the market is seemingly pretty quiet, where the Dow might be just down 150 points, we've seen over the last month a ton of sector rotation and movement between, for example, growth stocks and value stocks. And a lot of that has been, if you want to call it, blamed on the fact that interest rates in March rose from about 1% on the 10-year to 1.7 or so, 1.75 yesterday. And a lot of that has to do with growth stocks, and the similar would be for SPACs, which is essentially your $10 sitting there not earning any income. And so there's a time value of money, there's an opportunity cost. When rates are very low, you don't mind letting your $10 sit there. When rates move higher, there might be competing investments that might do better, especially if you're going to tie it up for 2 years. So if you think about a growth stock, their cash flows are 10 years out into the future. And so that if you discount it back to the future, that future income is worth less now whenever rates rise. And similar for SPACs, that money that you're not earning is now worth less when rates are going higher.
Perfect. So I want to transition now to diving into some of the questions that viewers have put in there. And again, if you have any questions, feel free to toss them in the comments. I guess before I ask the first question, just a quick comment. I saw there's questions related to, specifically related to SoFi. All the information that we're, legally allowed to share related to that would be on our website. If you go on SoFi.com and up at the top with About, you can go under Investors. I don't want to just act like I'm ignoring those questions, but there's restrictions on what, we can and can't say, so you can access the information there. Okay, so let's hop into the SPAC questions that we can answer. There's a question about, why are SPACs priced at $10 a share?
That's a great question. And I think it's just standard practice. There's just been, and if you look at these SPACs, there are variations, but there's some pretty similar terms for most of them. And I know there's one or two that have different terms, but they all seem to have roughly a $10 per unit and a warrant. There's some variation on the number of warrants you'll get. The separation of warrants is usually 52 days. And so I think that people are just sticking to the formula that works, and just $10 seems like it's a good number, especially for retail investors. I didn't mention it earlier, but if you think about what a SPAC is out there doing, it's making acquisitions, and some of those acquisitions are for companies that are private right now. So it gives the retail investor potentially an opportunity to buy companies that they wouldn't otherwise be able to buy, because usually to be involved in any kind of private equity, you need to be an accredited investor and so forth. So I just think that the $10, it just appeals to both institutional and retail investors. And folks are like, I'm not going to, mess with the formula.
Awesome. And when I first saw the question, I'm like, oh gosh, I've never, thought about this myself, but it's always curious to me. Cool. So next question would be, from a review and a timeline perspective, any insight into, how long the SEC normally takes to, review the merger from a SPAC perspective, and then the reverse merger throughout this process? Is there like a status quo? Is there, how do you look at this?
It's like 3 or 4 months, because unlike an IPO registration statement where the company's never been public before, the SPAC is actually already public. So it's a somewhat different process. And so they're looking at it, are there enough disclosure terms of the merger out there? And there might be some pro formas out there, but it's just a different process for the SEC to approve a merger versus, making sure the disclosures that are out there versus an IPO, which they might go back for 2, 3, 4, 5 rounds of comments until the SEC is satisfied. So to answer the question on the timeline, what we've been seeing is, 3 or 4 months as opposed to, years.
Perfect. And another question that I'm excited to get the answer to, because I don't know the answer to this question. Are SPACs uniquely an American thing, or do you see this in international markets, across the world? And does it vary from the ability to invest in international SPACs if they do exist?
Yeah, I don't know too many international SPACs. I believe that they're much more focused in America right now. But I do understand that because we, Nasdaq, that is, has operations in Europe. We run a number of different stock exchanges around the globe, including in the Nordics. And they are, for example, looking at this SPAC structure. And this might be also something that appeals to European investors, for example. So I think, to answer the question, I think it's mostly a US invention, if you want to call it that. But that doesn't mean, just like any other thing that seems to work, that it can't, because capital is fungible around the globe, that it can't spread and go to other stock exchanges. The SPACs themselves are not limited necessarily to domestic investments either, so they can have a global reach. And you could say, I'm going to make an investment of a non-US company, and that would be allowed so long as it's been disclosed in advance.
Perfect. And we got, I guess, a follow-up question related to something you mentioned earlier about, with interest rates being low and capital being, cost of capital being relatively low, companies are, able to stay private longer. I guess, what have you seen from a company perspective on, the differences between a company saying, hey, I'm ready to go public via SPAC versus I'm ready to go public via an IPO? And what would those kind of differences be from a company perspective?
I think when rates are low and there's an ability to raise capital from other sources, venture capital and so forth, the companies really are in the driver's seat because they're not forced to have to be public companies necessarily. And being a public company has a lot of obligations to it, a lot of disclosure obligations. For better or for worse, you're at risk of class action lawsuits once your securities are publicly traded. So there's a lot, and of course you have to be communicating with investors and giving quarterly projections in many cases. So there's a lot to being a public company, and there are, of course, benefits to that. Once you have a currency that's traded out publicly, then you can make acquisitions with that currency and not have to use cash. So there's a lot of trade-offs there. And so companies now have this other potential way of going public using the SPAC structure. And so I think, again, it leaves them in the driver's seat. They can choose to do the IPO route, but if they're approached by, 1 or 2 or 3 SPACs, let's say it's in the hospitality industry and you're a company that wants to go public there, you just have that option. So I think it's just more flexibility for companies.
Perfect. And as you're, from a high level, from a market perspective, are you seeing, SPACs as more of something that individual investors are investing in, or is there institutional investors investing in SPACs, or, how does that mix, normally look at a high level?
It's both. We definitely see institutional investors interested in that. There are hedge funds that definitely buy SPACs, and definitely retail interest. So we're seeing both, and I think it's both parties. One thing that a hedge fund might do is, if they have access to 10 different SPACs, they might decide to immediately sell the SPAC interest as soon as, they're able to, and just keep the warrants. And that could be a strategy where you have a bunch of warrants to give you upside for potential deals. Again, different strategies, but definitely we're not seeing it limited to any one type of investor.
Perfect. And that wraps us up for the questions that we had come in today. I guess, any closing thoughts or anything you want to add where I forgot to ask you and you're like, hey, this would be really valuable for people to know about or think about?
No, I wanted to just, kind of echo what you had said, is that it always boils down to each person's risk tolerance and all kinds of things, and any kind of speculative investments, you just, you want to have as a percentage of your portfolio, not everything. But I do think it's a unique structure, certainly for up until the deals are announced, and then just, be wary of the fact that once a deal is announced, if you choose not to redeem your shares, you are a shareholder in a new company. So, just, be aware of that. But I think it's just like we just said, for companies having more options, there are now more options for retail investors in terms of the kinds of investments they want to be involved in.
Perfect. Well, I appreciate you joining us today, and I appreciate everyone tuning in. For follow-up, again, if you do have questions about your own personal finances, you want to dive into that and, see different aspects of it, you can always schedule a call with one of our financial planners, or you can just explore information in the app related to SoFi Invest. But Michael, thank you so much for joining us, and hopefully everyone has a great rest of the week.
Pleasure. Thank you.